This channel is for educational purposes only. Please do your own due diligence before making any investment decisions.
Hi, this is Joe, and today what I'm going to do is answer a question related to basically ADX and why it's necessary. I got a question saying that, if I look at the moving averages, especially using an 18 and a 40, which is what I recommend, 1840 simple, why do I need to look at an ADX? And there are times when you don't necessarily need it, but I'm going to show you some examples as to why it does have some advantages. And I'm going to bring up some other things that you might not have thought of. So let's go ahead and get into this. Just before we get going, if you have an interest in learning more about some of these techniques, I would suggest starting with the book. I'm offering at a discount right now. Go to rabilstockresearch.com/book for more information. All right, so I've got a chart of the spider up. In fact, I've got the grid up with the monthly, weekly, daily, and hourly. And for anyone new to the channel, I like to use 18 and 40 as a buddy system together. So let me just pull up this weekly chart and give you an idea. So you can see when the two moving averages, here's the 18, when it's moving up at a pretty, decent rate. I like to think of it like almost like a 45-degree angle. And we have the 40 doing the same thing. We know we're in a pretty solid trend, okay? Now, if you look underneath the hood, now let me just, before I even get into any of this, let me just make sure you understand what I use each of these indicators for. So price is obviously the most important thing. It's the source code for all of these indicators, right? For moving averages, for the MACD, for the ADX. It's all based on price. So we got to know what we're looking at with the price. We have to understand price bars. That's why I added that as the first part of my course. That the first section of my fundamental course or foundations course is basically the bars and how to read them. Now, what I look at is if I use the moving averages to help determine the trend and define the trend. That's what I use them for. All right. I use the ADX to determine how strong that trend is. Okay. And then I use the MACD to determine whether we're in an area or we're getting a signal where we should be looking to be a buyer or a seller, depending on what you're trying to do. So this helps, the moving averages help with the trend, defining the trend, and make it very simple and repeatable. Depending on the environment, it's still going to give you very similar. Now, when we get V bottoms like we did in 2020, there will be some lag before you see a confirmation of the trend using the moving averages. But once we have that, then we go to the ADX and we determine just how strong is that trend. What is the momentum of that trend? Is it strong enough to continue to the upside, or should be looking for some kind of a reversal? Then we go and we look at the MACD, and if we're stretched away from the zero line to the upside, then we know it's probably not a great time to be buying unless we get one of our shorter term signals, which could either be a pinch play or a reverse divergence. All right. If we get down near the zero line, now we're starting to talk. We're getting into an area where we definitely should be watching for any kind of a buy signal. The other thing is if we get oversold, normalized or deeply oversold on a MACD basis, we should be looking for signs of reversal, normally on the smaller time frame. Now, we want to use all these together, and I've gone through a number of videos of how that would work, but let's just look at this period in 2021, which led to a very nasty period in 2022. All right, so if you just looked at the moving averages, the 18 is moving up. It's not really, it's moving up at a pretty good rate. You've got the 40 underneath moving also up at a very good rate. And the reality is, you could have been feeling really good going into the end of the year, thinking that everything was fine. All right. But as I've said numerous times, I like to think a few moves in advance. I want to know whether the current trend is losing strength or not. All right. If I go and look at what's taking place on an ADX basis, it was telling us starting in the summertime that this trend was starting to lose strength. Now, it's almost a little early from that standpoint, and that's why I don't create any kind of a trigger off of this indicator or even off the MACD. I am still waiting for price to give us a signal. And that's where the moving averages will come into play, a break of the 18, a break of the 40, something like that. But we want to know in advance. And sometimes, and one of the things that I'll say, and I've told my subscribers, is sometimes one of the weaknesses I have is that I see something developing so far in advance. Like I'm seeing it develop and I'm saying, okay, I know what's going on here, that it can almost hurt your shorter term trading because you think that that's going to kick in maybe a little sooner than it actually does. But I would rather know it in advance than not know it. All right. So there's a huge advantage with that. It's just, so hopefully you can see the difference here where the ADX drops down below 25 and then the market goes to another new high, and this can't climb and get back above 25. So we're making confirming peaks in the ADX, and then we just stopped doing that basically starting in July. And from that point on, we knew that the momentum was really slowing dramatically, all right? And then we start to be careful. And now later in the year, we got an increase in volatility. Now that shows up in the Friday video that I do when I do the market conditions. ATR of the S&P on a weekly basis started to really climb into the end of the year. And, so then we started to get enough evidence that we should really start to be concerned with any kind of a break of the 18 or any kind of, violent reversal or anything like that. So we want to know these things in advance. All right. Now, let me just show you another example. By the way, if you're enjoying the content, hit that like button and also subscribe. So another way that these can be used. So look at this 2023. We've got this low ADX pattern where the ADX actually late in 22, it drops down and gets low. And if you notice, both of the DI lines are also low. And we stay down there. All three stayed down there for an extended period. So when we have that, that's another thing. And that's something you can screen for. So I can say, give me all the stocks that have a low ADX below its 25. The ADX is below 25, but it's also below its two DI lines, the red DI and the green DI, plus DI and minus DI. And you could also say, I want both of those lines below 25 as well. All right. And if you do that, you're going to find stocks that are in a low ADX condition. Why is that powerful? Well, first of all, if we look at the moving averages, it's very hard to screen for that. You're not seeing it on a moving average basis. At one point, the 18 was declining below a declining 40, and then we're above 40. They were kind of flat. You can't really screen for it. It's very, very simple to screen for ADX. All right. So one of the big advantages of finding something that is forming a base, or I call it building energy for its next move. All right. So we want to be on the lookout for that. Now, this is significantly different than what I'm talking about here. We're talking about exhausting a trend where the ADX is low and does stay low for an extended period, but the trend is moving up. This is a different situation. We're moving sideways and kind of forming a channel and setting up for a new up move. All right. So those are two different ways that ADX can be an advantage to you. All right. And so you've got to know these things. Now, when we look at the MACD, we want to be on the lookout for signs when, say, the market is dropping. And here are the moving averages. We've broken both moving averages, but notice where we come in and find support right at the zero line. And then look at this move here. We make a move to the upside in early 23. And then again, we get a deep pullback and we break both of the moving averages. But look at what the MACD is doing. It's providing a pinch play right at the zero line. Okay, so I'm not saying that these are necessarily buy signals, but they're giving you different feedback. The MACD is giving you different feedback than what you're seeing from the moving averages. That's what I want. And what I teach in my course is if you're learning MACD, take off the moving averages and just have the price with the MACD. Don't look at the ADX, just look at MACD. All right, so you'd pull this chart up and you'd do this, and you'd actually take these charts off. You take these moving averages off, and learn MACD with price and see if you can see the signals and learn the signals just using MACD by itself. Now, once you've done that, then you want to spend some time doing the exact same thing with the ADX. You need to learn how to use ADX by itself without the use of moving averages or anything like that. Once you've done that, then you can put your moving averages back on. You can look at all three together. And at that point, I think you'll start seeing things again. If you get enough screen time and you look at enough charts, you're going to get really good at seeing this stuff developing well in advance. So let's just look at what's taking place right now. If we looked at what's taking place just using the moving averages, all right, the 18's moving up at a nice steady pace, the 40's moving up, and they look almost identical. I mean, in terms of the slope. The slope is basically parallel. But look at the price action. You can see it in the price action. And I guess if you get really good at reading price action, then you don't necessarily have to look at the indicators. But I just think it makes it a little easier if I can look down and see, here's the strength of this move. We knew we had a lot of strength to end the year. And then even as it continued to climb, we had plenty of strength in the trend. But notice what's taking place now recently. We're starting to die out. The trend is starting to lose some strength here. And we need to get a little bit more we got to start watching this a little bit more closely now. Whereas up until this point, you pretty much could have been okay with, as long as it held above the 18, you were okay. Right now, I'm starting to think, it's in a little bit more dangerous position. I mean, there's other reasons for me to believe that, and you can see the volatility is growing on this time frame as well. But the fact that the ADX has dropped down under 25, I think it warrants closer scrutiny, watching this a little bit closer on a day-to-day basis. So use these indicators the way I've described. Use the MACD for a timing tool. Use the ADX to determine the strength of the trend, right? Whether it's good strength in the trend, does it have the ability to continue, or does it look like it's slowing down? And then use the moving averages to help you define the trend. All right. I think if you stick with it if you use these indicators these ways, I think it can really help you understand what price is telling you. All right. Let me know if you have any questions. Thanks.